Principles of Accounting, Chapter 24. In Chapter 24, we look at capital budgeting. So, capital budgeting is looking at long term investments, generally pertaining to property, plant, and equipment. So, what long term investments we're looking to buy something very expensive. We generally have to plan for this ahead of time in order to make sure that we have enough money available to pay for it. So, the process for capital budgeting is that someone submits a proposal for a piece of equipment or a piece of property or a piece of software. The capital budget committee evaluates that and then decides whether they're going to approve it or reject it. And then a board of directors approves capital investments for the year. When we've looked at other budgeting chapters, most budgets comprise a month or a quarter or a year time frame, and they're updated continuously. Because capital budgeting projects run over multi-year spans, many capital budgets look at 5 to 10 year spans, planning ahead to when we want to start future projects so that we make sure that we have the money available for them, and to understand the fact that most capital project budgeting projects have to be paid for over multiple years. So we have to think about many, many years. Okay? A capital asset is an asset that's used for a long period of time. This could be property, this can be equipment, this can be software. The investment is the purchase of that actual asset. And then what capital budgeting is the planning of how we're going to invest in those assets, how and when. There are many different ways that we analyze capital budgeting projects that we're going to talk about in this chapter. So, capital budgeting decisions require a lot of analysis because they're multi year projects. We can only really guess at the outcome. So, we can only guess that we're going to save money over the next 5 years, or that this piece of equipment is going to be important to a business venture or a business decision. They require large amounts of money. So we're not talking about just supplier for products or anything. We're usually talking about several $1,000,000 of capital outlay. Usually, when we do that, it's a long-term commitment. So when we decide to buy a piece of property to use for 5 years or a piece of equipment, we're committing to a 5 year project or a 5 year process that usually we can't get back out of, especially if we're looking at building a new building. Once we start into that process of building a new building, we can't just walk away from it half finished, which means that the decision that we make is usually difficult or impossible to reverse. So, very important decisions, very large sums of money, but uncertain outcomes. So, when we're looking at capital budgeting, we want to focus on the cash flows, cash in and cash out. Revenue, so cash inflows are any revenue generated from the investment. Is it a product launch? And so we're going to have increased sales. Savings and operating costs. This new piece of software, this new piece of equipment is going to increase efficiencies, which decrease the amount of money that we spend. And what is the residual value or salvage value? Can we trade it in at the end for money? Different cash outflows are the initial investment. How much do we have to pay to acquire the capital item? Any operating costs? Do we have to hire someone to run it? Or are there monthly costs of management, yearly costs of maintenance? And then any refurbishment, repairs, or maintenance that we have to plan along the way. For example, um, If we're talking about buying trucking equipment for our company, do we have to plan for oil changes and replacing the tires after 4 years, different things like that. So, as I said before, common cash outflows and inflows over the life of the capital expenditure. So first, the acquisition, the initial cash outflow. We generally call this year zero or time zero in capital budgeting. The use, how it's going to be used to save costs or generate cash, and then at its disposal. We have four popular methods of analyzing potential capital investments. They are the payback method, the accounting rate of return or ARR, net present value NPV, and internal rate of return IRR. So we're going to start by talking about the payback method. The payback method is simply how long does it take for us to recover our cost. So the cost of the initial investment, how long does it take for us to make that money back? If the net cash inflows are equal each year, then the payback is the amount invested divided by expected annual cash inflows. So we'll look at this example here. We have a company that's considering buying a new machine that will be used in its manufacturing operations. The machine costs $16,000 and is expected to produce annual net cash flows of $4,100. The machine is expected to have an 8-year useful life with no salvage value, and we want to calculate the payback period. So I'm just going to do that right here on this slide. So we have 16,000 is the investment, and our annual cash flows are 41,000. So we're going to take 16,000. Forgive my writing with a mouse. It's terrible. Does that divided by 4,100? And that amount equals 3.9. So with the annual net cash flows of $4,100, it will take us 3.9 years to pay back that investment. If we have unequal cash flows, then we need to look at what the individual cash flows are in each year. So same machine, $16,000 capital outlay, but we have expected cash flows every year that are different. So in this, we look at each year at a time. So as I said before, that when we're looking at capital budgeting, year zero is the cash outlay. So our expected cash flows is when we buy the piece of equipment, that's considered year zero. We pay $16,000 for the equipment. Then in year one, if we have cash inflows of $3,000, we owe a remaining $13,000 on that piece of equipment. In year two, we receive another $4,000. Now we owe $9,000 on that piece of equipment. Year three, an additional $4,000, and so forth until we get to its paid back. When we hit the year that it's going to be paid back, then we know from looking at here that after year four, it has $1,000 left to be paid, so that it's going to be paid off sometime in year five. We take the remaining $1,000 divided by the cash flow for year five. So you see down here, 4 years plus 1,000 divided by 5,000 in year five. So we get 0.2 for that. So the total payback is 4.2 years of that $16,000 capital outlay. In this example, we see that a machine can be purchased for $150,000 and used for 5 years, yielding the following net incomes. In projecting net income, straight line depreciation is applied using a 5-year life and zero salvage value. We're going to compute the machine's payback period. So we have the cash flows or the net income that we're going to see from these different years. And we're going to look at this using straight line depreciation and double declining depreciation. And I'm actually going to pull up an Excel file to walk through this example. Okay, so looking at this example, and as I said, I'm going to pull an Excel file into the screen here so we can look at this example. So first, we're going to do regular straight line depreciation. So when we're looking at regular straight line depreciation, remember that is the historical cost minus the salvage value divided by useful life. So we have zero salvage value and a 5-year useful life. So our depreciation amount is the cost of $150,000 divided by our 5-year useful life. So our annual depreciation expense is $30,000. So, and then I'm going to lock that cell so I can drag that down. So straight line depreciation over 5 years, our annual depreciation is $30,000. Our net cash flow is net income plus depreciation. So remember, because depreciation is a non-cash expense, it gets added back when we're determining cash flows. So our annual cash flow every year is net income plus depreciation. So we're calculating our positive cash flows right here. So in year 0, that's when we buy the piece of equipment for $150,000. That's always negative. And then we have our cash flows for the next 5 years. This cumulative cash flow then is what's left over. So we're looking at payback. So in year 0, we paid out $150,000. So we have a negative $150,000. So in year 2, we've made $40,000. So we're going to add that $40,000 on. We have $110,000 remaining. Okay, so let's add year 2's $55,000 positive. So now we have $55,000, and in year 3, it's going to be paid off. Oh, here plus. So we continue to add. Okay, so a piece of equipment is paid off sometime in between year 2 and 3. So now we have to decide when exactly it's paid back. So we're going to pay off $55,000 in year 3 and we make $80,000. So when we're trying to determine that, we're going to take $55,000, so the remaining payment left, divided by year 3 cash flows of $80,000, and we get 0.6875. So the payback period for this machine is 2.6875 years. So it's going to take just over 2.5 years to pay that piece of equipment back. Okay. So that's under the straight line example. Now we're going to look at the double declining value. So with double declining depreciation, our depreciation is a percentage instead of just a normal amount. So that percentage is, first, what is the amount that we're looking to pay back? Well, we want 100% of the machine, and it has a 5-year useful life. So 100 divided by 5 equals 20. We're going to make that a percentage. So I actually want it to be 20%. For double declining, so that's DBB is how it gets, it's double that rate. So we're going to take that times 2. And so we have a rate of 40% is our double declining balance rate. So our annual depreciation amount is 40% of the book value. In year 1, our book value is 40% of 150,000. Seriously. It's 150,000 times 40%. So our accumulated depreciation for year 1 is $60,000. The ending book value is the original book value minus the accumulated depreciation. The ending book value from year 1 becomes the beginning book value for year 2. We are then going to take year 2, 90,000, times our 40% to get the year 2 depreciation. But now our accumulated depreciation is 60,000 plus 36,000, or 96,000. And so now our ending book value, original value minus accumulated depreciation, is 54,000. That becomes year 3's beginning value, and we just continue that till we get each year's depreciation. So 96,000 plus 21,000 equals 150,000 minus accumulated depreciation. Okay. And then now year 4 matches year 3's ending. We have our depreciation is the book value in year 4 times our 40%. We add that to our accumulated, and then we get 150 minus, okay. And then in year 5, and we want in the last year, you actually don't take the percentage because you're just going to finish off what is left. Oh, I multiplied 130,000 plus. So our accumulated now should be 150,000, and we have 0 left. So now that we have our depreciation amounts, we can bring those down into our table. So now we're doing payback with double depreciation. So we've got our depreciation amounts. We're going to add those. So for our cash flows, and then we're going to calculate our, now the nice thing about double declining balance is it puts all of your depreciation in early years, and so that's going to boost our cash flows for early years, which should impact our payback amount. So now we have the 150,000 investment plus 70,000, which is 80,000. We get plus year 2. And this is also going to be paid off sometime in year 2. Okay, so in year 2 we have, or sometime in year 3. In year 3 we have 19,000 divided by 71,600, and we get 0.265. So our payback is 2.26 years. So you can see with the double declining balance, we're going to pay it back 4 months sooner than we would have originally. Okay. So Payback has two strengths. It's easy to use, easy to calculate when do we pay this piece of equipment back, and it uses cash flows and not just income. So we should always focus on cash flows and not our net income. Payback period has some major weaknesses though. One, it does not reflect differences in the timing of cash flows. So when do those cash flows happen? It ignores all cash flows that happen after the point where the investment's costs are fully recovered, and it ignores the time value of money. Now we're going to address time value of money later in the chapter. So I'm going to pause here and I'm going to resume a new video with the next example, or the moving into the accounting rate of return. I try not to make my videos this long.